Is life insurance a scam?
No, it's not a scam.
Well, there's a misnomer out there.
Okay.
Like my cousin Nomer.
Go on.
My cousin Nomer
Please.
that I miss. I'm in the
Yes.
South. Cousin Nomer down at the filling station. You can still get a bottle of Coca-Cola for 10 cents.
Can you please, for the love of God and all things holy, just get to the point?
And now, That Financial Guy Show with Keith Wilson.
I see you came back.
Huh?
I see you came back.
It's the same session.
You said you wouldn't come back last time.
All I did was change shirts.
That's the magic of television, huh? Well, you came back from downstairs.
What do you want to talk about now? Nobody wants to listen to us ramble about. All right, wait. Actually, here we go. What is because we're going to talk about life insurance, right? What's the best excuse you've heard? Because how long have you been selling life insurance?
33 years, maybe.
Right, 33.
89.
I'm 19 years. Next year will be 20 years.
Uh-huh.
It was actually the first license I got was the insurance license. Yeah. So they would get you your life and health license first, and then your series 66, and then series 7. If you couldn't pass the life and health, they knew you had no shot at the securities licenses. So here's
to dumb it down, but
it's way harder. Securities license are way
harder. When I got a license, it was a spoof. It wasn't like I sought out to sell insurance. Okay, my girlfriend worked as a receptionist at this agency at the time.
Yeah, it all makes sense now.
I would go pick her up for lunch or whatever.
It all makes sense.
And all the guys are in there. They're trying to recruit.
Uh-huh.
And back then I had a mullet. I had an earring. I had the, holes in the knees. It was like Chachi on Happy Days.
I almost just spit my water out.
It was like I tried to look like Chachi on Happy Days or Rick Springfield. Anyway, they finally recruited me, and I said, okay. They said, here's a book. Go read it and then take the test next week.
Yeah.
I didn't go to a course. I didn't go. The book was about that thick. It was Life and Health.
Mm-hmm.
And I just studied and I took it. But anyway, we are going to talk about life insurance.
Here's my question.
Yeah.
So you've been selling 33 years, you said?
Yeah.
All right. I'm 19 or 20 years. What's the best excuse or objection you've heard in a meeting from a client, or not a client, but somebody who didn't want to buy life insurance?
I don't know about best, but I've heard I'm not old enough. When they're in their 30s or 40s, no, I'm not going to die. I'm going to wait till I get older to buy it.
Oh, okay.
What's the best you've heard?
The best I've heard. I mean, the husband's like she'll remarry. Like,
don't tell her.
That's horrible,
sir. Based on your financials,
well, I mean, you need
$2 million in life insurance policy. Would you shut up? She's sitting right there. I want to sleep tonight.
But I mean, if you really unpack that comment, that's a horrible. She'll remarry, is what this guy said, and he didn't buy anything, and he's not a client, but.
Well, there's some other issues there.
Well, my younger self, just trying to survive and sell insurance, and you brush it off, and you don't really think about comments like that. My older self is like, what a piece of crap! Like, who in their right mind
would think that right off?
Who really would subject their your wife and your family? That is your financial. That's how you would financially survive, is you've got to get into another relationship with somebody. I replay that comment in my head, and I'm like, what an absolute piece of crap that guy is.
Yeah. I think there's still some other issues there.
There's way more issues.
All right, life insurance. I want to bring this up because
I actually had a guy.
Okay, we're going to continue to ramble.
No, I remember. So again, 25, 26, another guy. His objection was, I've got $25,000 worth of coverage at work. He worked for Hendrick Automotive, and he had a $25,000 or a $50,000 policy. I was 25 at the time. I think he was 26 or 27. His wife was 26, 27. And all I said to him was like, hey, you could get for like $20 a month, you could get like a $250,000 or $500,000 just 20-year term policy. I know you're young, you probably don't need it, but I think it was, I was like, my manager was like, at every meeting you have to ask for the insurance, because I was enrolling people in 403Bs, and he's like, every meeting you just ask for it, and we were okay, whatever. So I'm just doing what they told me to do, and he said, no, I don't need it. I've got $50,000 worth of. I'm like, whatever. The guy's 26, and that was, I asked for it, nothing. I was sitting at my counter, and I never forget, I was eating a bowl of cereal, and I was reading the newspaper, and I was flipping through the newspaper.
Don't tell me.
The guy, the 27-year-old dude, was in the obituaries, like probably 5 months later.
Man.
5 months later. And the wife was a client. I had no idea. The wife, I call him a client, but I enrolled her in her 403B, and she's putting away maybe like $50 or $100 a month or something like that. Teacher, and I remember being shocked. I was like, holy crap! That's the first time I ever had somebody say, that early in my career, somebody said, no, I'm not buying life insurance, and they died. That was like that was crazy.
It was an eye opener for you.
Yeah, crazy.
So, speaking of that, we do want to talk about life insurance,
Great.
somewhat in general.
That's why I love it. You're always like, "Are you prepared for?" I'm like,
he's never prepared, folks. That's the beauty of Ruffalo. The rough is off the cuff rough. I like it.
Off the cuff.
Off the cuff rough is what I call him.
Just life experience.
Yeah, but let's get back to life insurance. I want to talk about, there's a lot of people, if they follow us, especially on LinkedIn, and we talked about this the last episode, but I want to bring it up again. I don't know, 5 years or so, you were the brainchild of something called Truthful Mutual, that we just ran with it. And it was really, it was a parody. It was sarcastic. It was satirical about the life insurance industry in general, and more about the agencies that push the insurance agents and that sell it improperly. Since then, you and I on LinkedIn especially will get comments about, you guys just don't like life insurance. You guys just don't like life insurance. I want to set the record straight. So you and I, for the last 5 years or so, we started that series, Truthful Mutual, and it seems like we're bashing insurance, and we're not.
No.
We're bashing the system, the agency behind people pushing products in an inappropriate way. So, record straight, I love life insurance. It's the cornerstone of a financial plan. I recommend it all the time. I have an issue with the way it's presented and the way it's pushed and misrepresented, with all these people on TikTok and social pushing IULs as a way of infinite banking. So, record straight, love life insurance, recommend it all the time. The right types of life insurance for the right person, for the right need, goals, and objectives. So that record is straight. So I want to.
Are we done now?
We're end of episode. Thank you for joining.
Can we wrap this up?
We can wrap it up. No. Let's talk about the permanent insurance and your thoughts on, and my thoughts too, because we're co-hosting, even though that
but
says...
But mainly my thoughts.
Yeah, you'll see in a minute. It's going to be mainly him. But it still says that financial guy.
Yeah.
So I guess they have to decide who's
those
financial guys.
Financial people's, them, they.
What do you think about this infinite banking? And
it's called infinite banking because that's how long it takes you to make a return on your money.
It's
infinity. You have to have an account for infinity before you actually see a return.
Right. Well, let's set up the premise for people who don't know what we're talking about.
I don't want to waste my time.
No, it's just it's a permanent insurance like an IUL whole life where they're structuring it where the death benefit is super low, trying to fund it with as much cash value, and they say, hey, you can borrow against that, take out a loan, it's tax free, and all of that, and they're promising these great returns.
Well, we're so you've heard where you get in trouble with an IUL on those policies is what they're doing is they're telling you to borrow against the policy within the policy. It's called participating loans. So what they'll do is the insurance company will allow you to borrow against the policy and then reinvest the premium back into the policy again. The issue is that there's a cost to borrow, 4, 5, 6, whatever the percentage is to borrow, and then because it's participating, it means you get to participate in the underlying index or the derivative that you're investing in, and that may or may not earn money. So you've got in a perfect world, you get the market return or the cap rate of return at 8 or 9%, and you borrow at 6 and you arbitrage the 3. That's in a perfect world. However, we all know assets don't always go up in value, and insurance carriers reserve the right to they drop cap rates, they change participation rates, they can raise the cost of borrowing. Then there's the individual. The individual can run into cash flow issues where they can't make premium payments anymore, or they actually need money to go spend on something, and they've got a loan problem against the policy that they have. So you have the insurance, the economics of the insurance company that you have to deal with. And then you also have the behavioral economics that you have to deal with. And the behavioral economics are, you've seen it you've been an advisor for 30 plus years. You see how there's no way to quantify the behavioral economics. And that's because that's life.
My big thing is I just separate the two. Let the insurance policy be insurance. Let investing be investing, because when you're trying to combine the two, you're taking away the best part of each. So that being said, all these promises that you see on social and Instagram and whatnot saying $1 million in cash value. I have never seen a client come into my office with $1 million in cash value in life insurance. Have you?
No, never.
How many times have you seen someone come into your office with $1 million in their 401k?
Many times.
Many times. So separate the two.
Or how about this one? How many times have you ever had somebody come into your office and say, hey, my grandparents bought me this life insurance policy and it paid for all of my college tuition? That's never happened to me. What has happened to me is my grandparents bought this XYZ stock for me.
It's highly appreciated.
And that's how they paid for all or a good part of college. And there was even some left over.
Now, that being said, I get a lot of comments and messages about, oh, you just like term insurance, don't you? No, I like permanent insurance, like whole life insurance, in the appropriate place. So I'll give an idea where I think permanent insurance is suitable, and then you give me an idea. One would be simply, I want a death benefit that's going to last the rest of my life, not just a specified term, because I want to leave a death benefit to my heirs, tax-free. And I got to make sure it's going to last the rest of my life. So legacy planning would be one.
Sure. Legacy planning, that would be one. Two would be, if you just want to, if you want to earmark something for taxes, if you're ultra high net worth in the ILIT space. Now, those are far and few between because the estate tax exemption is so is so high now, but we may see a change in that tax law, making the ILITs more attractive. And real, high level ILIT is basically you have a trust that purchases and owns a life insurance policy, so it's not includable in the taxable estate when somebody passes, and then those assets can be used to pay the taxes. And the equation is what's more expensive, the potential estate taxes or the premiums to the life insurance company. And hopefully, if the math works out, you wind up paying way less in premiums to the insurance company to get that asset out of the estate than you would wind up paying in income taxes to the government. That's a smaller application. But
do you remember though? Speaking of estate tax, when the estate tax exemption was everything over $600,000.
Yeah, I think I was 11.
611?
No, I was 11 years old.
Oh, that's right. I remember when the estate...
You were mid-career then.
The estate tax issue was $600,000, and obviously they've raised it up. So it's not as prevalent now for ILITs, which incidentally stands for Irrevocable Life Insurance Trust. Like you mentioned, the trust owns the policy. So 2 applications where we think permanent insurance makes sense. All right, there's applications for permanent insurance. How else do we use insurance in our practice? Term insurance is another.
Sure.
Which I use more often than a permanent insurance application. So term insurance, obviously term meaning if you bought a 10-year term, you're really insuring the next 10 years of life. 20 years, 30 years, 40 years, whatever term you select. And obviously the longer the term, the higher the premium. But it's a pure death benefit play. Mm-hmm. It is no cash value to it.
It's protection.
It's just protection. Now, for what purpose? One of the main ones is if to protect your income. If you were to die prematurely, you want to protect the income that would be lost to your heirs, your spouse, or children, or what have you. So usually we design a term policy up until the age of retirement. Once you retire, then you no longer have earned income. So you're only insuring that risk that you have of dying prematurely up to
and I would say that
retirement.
Your biggest if you looked at it at a bell curve, your biggest risk is just until your kids are like 18 to 20. Once your kids are 18 to 20, typically that means you should probably be in your 50s or maybe even your 60s at that time, which means you should have accumulated assets by then, which means you should have managed all of that risk, which means you should be in a much better off position. So once the kids are gone, you're probably older and you likely don't need that much life insurance coverage at that time. The children are the biggest drivers of risk.
Yeah, I still would say carry to retirement. I have some people that will have
because
multiple policies.
Why do two people? If you don't have kids, then there's no reason why 2 people can't work. What else are you going to do? They're bored.
Well,
you don't need somebody to stay at home and take care of what.
Well, that's where the financial planning comes into play with life insurance.
Exactly.
Because not every couple is the same. One may be a stay-at-home spouse taking care of the kids up until, I have had it many times where, let's say, mom stays home with the kids and she never goes back into the workforce.
Mm-hmm. And
if dad stays home, it's the same thing.
No, I see it.
I see it. It doesn't matter. It's if mom or dad stays home, never goes into the workforce, the working spouse passes away, how is that surviving spouse going to re-enter the workforce with a decent income?
Right. Correct.
So again, that's where the financial planning comes in and say, okay, how long do we need this protection? But where I was getting at is I have some people will take out multiple policies. First when they get married, I got to protect income. Maybe a few years later, we've got kids. let's have another policy. We'll call it the kids' college fund policy in case I die prematurely. And then we have to look at debt.
Yeah.
So maybe we've got a large mortgage. There used to be mortgage insurance.
I actually got one because
You don't see it that much. And all
I
it
got a
was
letter
was
for it.
a decreasing death benefit.
Yeah.
And it was all about
It's a ripoff. It's decreasing
insuring
term
the more. I know.
because your premiums don't decrease.
No. But there are various uses with term insurance.
Term is just it's pure risk management, and it's the biggest bang for your buck.
What I tell the 20-year-olds, 20-somethings that come in, get a $1 million policy, term policy, like a 35-year term, because they're younger, they're healthier, they're probably going to get a super duper preferred rate, and at say
cheap.
25, it's nothing, it's pennies, and you're planning ahead for something that may come up. Where you're going to get married, maybe have children, and then you've already got that piece of insurance under your belt, locked in at that lower rate.
Sure, I had this conversation with another younger female, Danielle Darling. I don't know if you've seen her around. So she's with LPL. And I commented on one of her LinkedIn posts because she does a lot of work with younger females. And I said, hey, if I was you, because my wife had breast cancer. And when, going through that experience with my wife, I realized, the statistics around breast cancer. It's staggering. One in eight women in the United States will be diagnosed with breast cancer. That's 13% of the female population is going to be diagnosed at some point in their lives with breast cancer. And then it's 40% of people in the United States are going to be diagnosed with some type of cancer. So, and for women in their 40s are getting diagnosed at a faster rate than ever before. So my advice to her, I said, hey, you have a little bit of influence you're a younger female advisor. You have a little bit of influence in that community. I would be building into your presentation, just urging younger women to get insured for exactly what you're talking about. Pick up a $500,000, $1 million, just cheap term policy before you get hit with any type of diagnosis. Right. With breast cancer, if you get hit with that diagnosis, at the very least, you're temporarily uninsurable. But believe it or not, there are some types of depending on the type of breast cancer and the staging of the breast cancer when it's treating, you could still be insured after 5 years of being cancer free. So it's not totally. You're not totally disqualified, but it's likely that you're going to be disqualified, and it's also your rates are going to be much higher than if you were, obviously qualified while you're young and healthy.
Young and healthy is the key.
Yeah, it's been an eye-opening experience how fragile health is, and the longer that I'm in this business, the more of these stories I hear from everybody, colleagues. I can't tell you how many financial advisor colleagues I have that say that they wish they bought more insurance on themselves when they were younger because they've been diagnosed with things.
Which gets to this point. I threw out to the 25-year-old, go get $1 million policy. Well, how much life insurance does someone need? Mm-hmm. And the answer is a cop-out answer that really all financial advisors give, which is it depends. It depends on where you are in your life.
Do you have your depends on?
I don't know. Sitting with you makes me want. No, I don't have my depends on. But it depends on where you are in your life. We look at income because that's one of the main reasons to protect income. We look at, hey, do we have kids? How old are they? As far as college funding planning, if you were to die prematurely. Then we look at debt to pay off mortgage. We don't want to saddle a surviving spouse with a lot of debt and no income replacement. So that this rule of thumb out there, oh, you need 10 times your salary is kind of bogus, really. I mean, that looks good on paper for somebody sitting at home online. I need to buy life insurance. How much do I need? 10. Let's multiply my salary by 10. That could be far less than what you need.
Yeah. The truth is I find when I go through a financial plan, I find people that are underinsured and I find people that are overinsured, just because they haven't really gone through the analysis. And that's part of what we talked about was retirement education survivorship. The survivorship component of the financial planning process, we go through what is it, what are the asset transition, what does that look like? What are you left with? And we play it out. I think at the very least, what you're going to want is you want to clear your debts. And if you have a spouse that's not working, you want to make sure that spouse, there's a carve out for some education. If that's important, that's part of your value system. There's a carve out left for income. So how much income do you want to leave that spouse, and for how long? Mm-hmm. 5 years, 10 years, to the kids are 18 and on their own, or in perpetuity? And the answer to those questions and walking through that exercise, because everyone's mortgage is different, everyone's debt is different, everyone's philosophy on education is different.
Then it becomes a math thing.
It's just mathematical.
It's so that you can't go by the 10 times salary rule.
Right.
It's all about financial planning.
So that's how you get to and then you have to back out the assets, the existing assets, and that's how you get to the right number. Sometimes that number might be too big, and there's a budgetary constraint. If there's a budgetary constraint, well, then you just buy what you can get close to, because at the end of the day, through that exercise, that survivorship exercise, I'm the one, we're the ones that are going to be sitting across the table from the remaining person, from the survivor,
and delivering that check.
It's not even the check. It's so much more than a check. It's what do I do now? And that part of the survivorship, because on the last time we didn't get into it, but part of that survivorship, I have the more so for the older on the distribution side, for the decumulator side, we'll walk through what do you want to see happen for your spouse? How, if like if we're in a meeting, sometimes I'll kill off one of the spouse, like, you can't, you're not allowed to talk, you're not here.
You really say it like that.
Yeah, what happens, and then let them play it out.
Yeah.
So,
have you ever gotten calls just out of the blue? Yeah, I need to get a quote for $500,000 policy. Never got calls like that?
Yeah, not really.
No, they just out of the blue.
I have.
All they're doing is well, it used to be, oh gosh, I'm telling my age now, but in the yellow pages, I used to be in the yellow pages. Folks, there used to be like a telephone book where they put people's numbers in. And in the yellow pages was the business section.
People used to speak on the phone?
Yes, we all had landlines. But people would just call and just want a random quote. The point that I'm trying to make is it's not a quote machine. It's what's the plan? What's the financial plan that you're talking about and alluding to, and walking them through what do you want to happen with your spouse if you were to die prematurely. So I think that's going to do it for our life insurance talk. It wasn't that boring.
It was.
Yeah, it was? Are you going to come back?
Nope.
Still won't?
Nope.
All right, we'll see you next week.
Never.
Never? All right, that's
Nobody wants to listen to us talk about this boring crap. I promise you. This is like there's 10,000 other podcasts I'd rather be listening to.
If you like what you're seeing so far, check out this next video. Subscribe to the channel. Lord willing, we'll see you next time.